All right, so we finish up chapter 20 by talking about, among other things, the partnership accounting periods, their accounting methods, and tax elections. As far as tax elections are concerned, these elections include the election of the overall accounting period or method, the election to expense a portion of the organizational and or startup costs, and the election to expense tangible personal property and the method that they're going to use to expense tangible personal property. As far as accounting methods, for the most part, partnerships can use a cash method of accounting. The one exception is where the partnership has a C Corp partner. If they do, they must use the accrual method of accounting. The one exception to the exception is that you can use cash method even if you have a C Corp partner if the partnership's average gross receipts for the last 3 years were $5 million or less. Whoa. Guess I should blow this out, huh? All right. As far as the accounting period is concerned for the partnership, what the Revenue Service wants to do is make sure that there's no mischief going on here by a partner being able to defer reporting income of the partnership. And so they require that the partnership elect an accounting year end that causes the least amount of tax deferral to its partners. And so they give this example here, kind of extreme, where if they didn't have this rule in place, a partner could essentially defer up to 11 months of income reporting. So here in this example, the partner has a 12/31 tax year end, and the partnership has a 1/31 tax year end. And so because the partner reports the income of the partnership within the year, well, since the year end of the partnership is within that second year of the partner, that's when that partner would report the partnership's income for that first year. And so that allows for a deferral of 11 months of income reporting on the part of this partner. So the IRS wants to stop this sort of mischief. They're all about expensing sooner and, well, reporting revenue sooner and expensing later. So we have to run through these three tests in determining what tax year end we're required to use for the partnership when you have multiple partners. And so the first test is called the majority interest taxable year. And so this test requires that the tax year be the tax year of one or more partners who together own more than 50% of the capital and profits interest in the partnership. So if you got one partner who owns more than 50%, the partnership's going to have to elect that partner's year-end, tax year-end, as the partnership's tax year-end. Now, if you've got two or more partners who own a majority interest, the only way this test works, is if they have the same tax year end. If they have different tax year ends, then you got to go to the next test. And so the next test is called the principal partners test. And under this test, the required tax year is the taxable year that the principal partners all have in common. And for this test, principal partners is defined as those who have 5% or more interest in the partnership profits and capital. And so their example in the book is you've got two partners who hold 20% of the partnership interest, and then you got all this scattering of smaller partners who hold less than 5% singularly. So, if those two partners have the same tax year end, then that's going to be the year end of the tax partnership, or the partnership. So, but if in this example you have these two partners have different tax year ends, then you're going to have to go to what we call the least aggregate deferral test. And so what this test does is it takes each partner's interest and multiplies that interest times the amount of tax deferral for each possible tax year end you could have. And the possible tax year ends are the tax year ends of each partner. Okay? So they have an example in the book that I encourage you to look at, example 20-13, where you have three partners. One has 20% interest, and the other two have 40% each. And so one has a tax year end of 12/31. One has a tax year end of 6/30, and the other 9/30. And so those are your possible year ends: 12/31, 6/30, and 9/30. March 31st is not a possible tax year end because none of the partners have that as their tax year end. And so to determine the least aggregate amount of tax deferral, you simply multiply the percentage of each partner times the amount of tax deferral under each possibility. And in this case, you're going to come up with three possibilities, and you're going to take the least aggregate deferral of those three possibilities as your tax year. And so it's kind of like reading a cookbook. Just follow. I think I asked a question on this in the quiz, and probably the assignment as well. And so simply understand the format of the problem in setting up this least aggregate deferral situation and run with it. The possibility with the least aggregate deferral is going to be your answer. All right, so we have to report the results of our partnership operations, obviously. That's what the 1065 is all about. And so You would think this would be easy. It's quite different from the reporting of corporate income or loss, though, because partnerships are required to report their business income or loss, and they also have to report what we call separately stated items. And so these separately stated items are separately stated, are segregated from the ordinary business income or loss, because these items are maybe and probably are treated differently by each partner, or at least these separately stated items have the possibility of being treated differently by each partner. In other words, each partner has their own tax situation, their own tax bracket, things like that. So, for instance, capital gain, if you have a capital gain within the partnership, that's a separately stated item. And because each partner has their own tax situation, that's going to be taxed differently depending on each partner's tax situation. Some may be at the highest, some partners may be at the highest tax rate and be taxed on that capital gain at 20%. Some may be, somewhere in the middle and be taxed at 15%. And then maybe you've got some partner who's on the low end of the spectrum as far as their marginal tax rate and may be taxed on that capital gain at 0%. So that's why they have to be separately stated. And so partnership income or loss, or ordinary business income or loss, is, as you might, this is like duh. Partnership ordinary business income or loss is everything but the separately stated items. And so separately stated items share one common characteristic in that they're treated differently from the partner's share of ordinary business income or loss for tax purposes. And so, along with capital gains and losses, both short-term and long-term, those are all separately stated items. Also, 1231 property gains and losses are separately stated items, as well as charitable contributions and dividends. Again, dividends kind of like capital gains. 1231 gains and losses are treated like capital gains as far as their taxability. So how they're taxed depends on a particular partner's tax situation. That's why they have to be separately stated. And of course, here are some other separately stated items. Interest income, guaranteed payments. We'll talk about that in a minute. Net earnings or loss from self-employment, tax-exempt income, tax-exempt income could be treated different. Net rental real estate income, investment interest expense, and 179 deduction. So, now, what is moving on to, And for the separately stated items, look at example 20-15. Okay? That gives you kind of the setup for how the partners report not only their ordinary business income or loss, but also those separately stated items of income or loss. Now, guaranteed payments. And again, we're under reporting of operations, are separately stated. We just saw that in the example. These are fixed amounts that are paid to particular partners regardless of profit or loss earned in the partnership. They're kind of like salary. And so it's these guaranteed payments are, because they're like salary, they're treated as ordinary income by the partners receiving them. You know, if not all the partners may be getting the same guaranteed payments, and some may not be getting any guaranteed payments. So that's why this has to be separately stated to the partner receiving a particular guaranteed payment. The guaranteed payment is deducted in computing the partner's ordinary income or loss for the year, and like I say, separately stated to the partners receiving them. Don't want to spend a lot of time on this next subject, but depending on the amount of participation involved by a partner, the particular partner may or may not be subject to self-employment income. They get into this discussion of especially dealing with LLCs, where the law is kind of unclear as to whether or not LLC members receiving guaranteed payments should be subject to self-employment income or loss. And so that's kind of beyond the scope to talk about that, but just beware that that could be an issue. As far as compliance, the partnership reports their partnership operations, income, expenses, etc., separately stated items on Form 1065. That form, with your attachments as well, that form has to be filed by the 15th day of the 4th month following the tax year end of the partnership. And so, you know, if you've got a calendar year end for the partnership, they would need to file their return by April 15th. Of course, they can get an automatic 6-month extension if they file the proper form by that 15th day of the 4th month. And so, along with Form 1065, they also file this Schedule K, which lists the partnership's ordinary business income or loss and the separately stated items. So look at page 24 through 26. That shows you examples of 1065 and Schedule K. What gets sent by the partnership to the partner is this K1. They're included in the 1065 that's filed, but a copy is also sent to the particular partner so that they can report their share of income or loss, ordinary business income or loss, and or their separately stated items. Back to the partner's adjusted basis. I mean, we talked about their initial basis and all that, but unlike the corporate shareholder, whose basis in stock remains static as long as they hold it, the partner's tax basis fluctuates up and down as income increases or decreases, and as debt increases or decreases, and as distributions are made. Also, non-deductible expenses, ordinary business losses, and separately stated expense or loss items can decrease. So let's just go through these real quick. Okay, so the partnership is required to keep track of what they call each partner's capital accounts, which the capital account simply is the partner's basis, their ownership interest in the partnership. And so you have to make these adjustments to the partner's basis for increases of actual and deemed cash contributions to the partnership during the year. You have to increase the partner's share of ordinary business income and separately stated items of income or gain, as well as tax-exempt income. So those are increases to the partner's capital account. And then decreases would be for actual and deemed cash distributions made during the year. You know, understand, and we talked about this a little bit in chapter 15, you know, partners get this K-1 and they're required to list their taxable income in the partnership, their portion of it, and so they've got this tax liability regardless of whether or not the partnership actually distributed any cash. And so it makes sense that maybe not all the time, but at least some of the time, the partnership's going to have to distribute some of this cash in the partnership to the various partners. Number one, so that they can pay their taxes, and number two, just to pay other bills, put beans on the table and stuff like that. The other decrease to a partner's capital account would be from the partner's share of non-deductible expenses, such as fines and penalties, etc., ordinary business loss, and separately stated expense or loss items as well. So just keep that in mind. The partnership's required to do this once a year. Usually it's done at the end of the tax year. So think about this. For cash distributions made by the partnership to its partners, well, Is that taxable when the partner receives a cash distribution? Well, the answer is no, because they've already been taxed on that. They were taxed on the income when the partnership earns it. So the partners are taxed on the income when it's earned, not when it's distributed. Now, if cash is distributed when partners have a positive tax basis in their partnership interest, the distribution represents the distribution of profits that have already been taxed. It's a return of capital that was previously contributed by the partner to the partnership. Or it could be a distribution of cash the partnership has borrowed, or some combination of the three. Now, if you have, and this kind of looks like what we talked about in corporate tax, right? This kind of looks like the second and third level of talking about distributions of property. You know, the non-liquidating distributions. You know, it's a return of capital, and then anything, you reduce your basis, and anything in excess is treated as a capital gain. So, cash distributions in excess of a partner's basis are taxable as capital gains, generally. We're not going to really talk about the loss limitations, so I think I'll stop our lecture here and not make you responsible for pages, middle of page 29 on.